We're here today with Dan Cooper from Royal LePage. Now, Dan, in our series, Educating Ourselves About the Real Estate Market, what is it important for us to find out about today?
Well, we're going to spend some time talking about mortgages and financing again, but more specific, conventional versus high ratio mortgages.
And that's important for us to know?
It is, because the whole mortgage financing industry is very confusing, and there's so many terms, conventional versus high ratio, variable. I mean, there's just so much to try and figure out in the day that it's very confusing for even people that are in the business.
Is there someone that can take that confusion out of my mind?
We're going to go back and see Brian Girton with Mortgage Intelligence, and I honestly feel he's got all the answers.
Love to find those answers. Thank you, and we're on our way. You're watching Daily Web TV. What is the difference between a conventional and a high ratio mortgage? Well, we need an expert to ask that question to, and we have our expert, Brian. Now, Brian, you are very highly recommended by Dan Cooper. Dan Cooper sent me to talk to you today about mortgages. So what is a conventional mortgage and what is a high ratio mortgage?
Okay, well, most people don't understand how mortgages work.
Me included.
Okay, well, the money the bank lends you is not their money, it's money in trust, okay? And the Bank Canada wants to make certain that that money is not jeopardized. So you're required to have at least 20% down when you get a mortgage. Now that's called a conventional mortgage, okay?
Right.
You've got equity at 20% down. The bank is comfortable that they have equity, so that if unfortunately that deal goes sour, there's equity in the property, so the bank's not going to lose any money and jeopardize people's savings.
Right.
Okay, but most people do not have 20% to put down. We have what we call a high ratio mortgage. Now these are mortgages which are insured by Canada Mortgage and Housing, and when they insure that mortgage, they guarantee that if that deal goes sour, the bank doesn't lose a dime. Okay?
Right.
It's default insurance. So anybody who buys a home who do not have 20% down in Canada required to have that insurance. And you pay a fee, an insurance fee, okay? And the insurance fee is prorated so that the more money you put down, the less the insurance fee. An example, if you put down 5%, which is the minimum down payment, the insurance fee is 2.75 of the mortgage amount. Now, the good thing is, it's added to the mortgage. Okay?
Right, so you don't have to come up with that extra amount.
Yeah, and then another thing too is we offer extended terms, like going 30 or 35 years. Now when we do that, there's a surcharge of 0.2 per 5 years. So if someone takes a mortgage with 5% down and it's 35 years, that insurance fee will go from 2.75 to 3.15. And again, it's added on the mortgage.
Right.
Now if you put more money down, for example, if you put down 10%, that insurance fee drops to 2%.
So you need to kind of do the math to see where your breaking points are and how that affects your term?
Yes, okay? And the whole idea is if you can put more money down, it's going to save you money. But of course, a lot of people are, just, scraping for to have the 5% down, so they have no choice.
Right.
But they get the enjoyment of getting your home now and not down the road.
Right, and you can start paying the mortgage and owning your home as opposed to paying rent.
Correct. Yeah.
Now, what types of mortgage are there? I've heard of fixed rate. What are the other types of mortgage?
Okay. Well, fixed rate, okay, is whereabouts the rate is fixed for the term. Now, most people will take a 5-year term so that they're on say a 25 or 30 or 35-year amortization to make the payments comfortable, but the rate is guaranteed for that term. At the end of the 5 years, your mortgage will come up for renewal. You would then have to renegotiate and get a good rate at that time. Now, another product is called a variable, it's a floating rate. It's tied to bank prime. Now, last year, or actually prior to August, okay, before we got into this credit crunch, we were doing variables at prime minus 0.6, okay? So whatever bank prime was, your rate was minus 6. But now that cheap money is no longer there, so now the variable is prime plus 0.8.
Which is still a really good rate.
A good rate. But right now, I'm not recommending variable, because the rates are at all-time low. Fixed rates, right now we're doing a 5-year fixed at 4.39. So, you've got peace of mind, you know where your rate is, because bank prime a year ago was 6%, okay? And when things turn around 2 years from now, inflation is going to kick in and bank prime will start going up. And they're predicting it in 2 years, prime could be up 2 points. So if you're at 3.8 today, you could be at 5.8. So comfort zone is right today. We recommend taking a fixed rate.
Right. And someone like you can advise and guide us. Now, to get that advice and guidance, we need to reach you. So how can we do that?
Well, you can reach me by phone. My office number is 905-842-4320, or go to my website, www.bestdealmortgages.com.
Thank you so much. That's great information. And if you want more information, be sure to contact Brian. I'm Mariel Bradley, and you've been watching Daily Web TV.